Parker, you wrote your 18th piece in that series recently. Bitcoin is not a hedge, and that's what I wanted to ask, because a lot of clients, a lot of my friends and family, they always bring up this question. Now they say, Bitcoin was supposed to be this inflation hedge. What happened? It totally failed. You see it in the media. Oh, Bitcoin failed as an inflation hedge. How do you respond to that?
Yeah, I think that, well, first I would say that Bitcoin does meet the classical definition of an inflation hedge. I think that, the piece that or the point that I make in the article that I published a few weeks ago was that it can also meet the classical definition of an inflation hedge, but it is really the solution to monetary inflation, and that monetary inflation is a man-made phenomenon, and that there's a lot of debate about what causes it or what doesn't cause it, but that, in my view, it all comes from the Federal Reserve, who's really the only one who can create dollars, and the Treasury can print dollars, but the Fed creates them. And that if, it really centered around the fact that over the last 12 months, I got that question more than any other single question. If Bitcoin is an inflation hedge and there's inflation, why is Bitcoin going down? Right? Everyone consistently came back to that question. And as when I first went down the Bitcoin rabbit hole, and I went down the Fed rabbit hole really in parallel and independently from that, I came to the conclusion that Bitcoin was the solution to the dollar. That was my aha moment. And so in writing the piece, Bitcoin is not a hedge, I tried to lay out that framework of and kind of seeing it in my own circles, where it would be like Bitcoiners trying to make the case that Bitcoin is money and sound money and that it's better than the dollar. And then when they would fail, it would be like, well, it's a hedge. Like, even if you don't
Right.
accept that it's all of these things, and that realistically, Bitcoin is something. And in my view, it's money, and it's better money than the dollar, and it will ultimately replace the dollar. And that people really can only exist on two ends of the spectrum. They'll exist somewhere in between for a period of time. But once they start to see Bitcoin as money, it is inevitable that they will ultimately see it as a replacement. And that it actually confuses a lot of people by describing it as a hedge, whereas if someone's investing in gold or gold futures, they're really generally doing that to get more dollars. If they're investing in real estate as an inflation hedge, they're really doing it to get more dollars. And when people figure out that Bitcoin's a better form of money, they start to accumulate Bitcoin because they recognize that they're going to need it to buy food and to get gas, and those are two very different things.
Right. People start to use Bitcoin as their unit account. It becomes, hey, how can I stack more Bitcoin? Not like a traditional hedge where you're buying, like, say, like you bring up oil futures contracts, how you're trying to hedge that uncertainty. A little bit different with Bitcoin because it's like a more permanent solution. But you did bring up this idea of the Fed and the Fed printing dollars, and how, Bitcoin's price will fluctuate with the Fed turning those valves, with their central planning, pulling liquidity in and out of the system. And I would like to go to the topic of liquidity because I think it's super important. And Stanley Druckenmiller had a quote saying, earnings don't move the overall market. It's the Fed. Focus on the central banks and focus on liquidity. But there seems to be a debate about what's the best measure of liquidity. People look at M2 money supply growth. People look at the dollar. People look at net liquidity, looking at reverse repo rate, Treasury general account, and the Fed's balance sheet. Lynn, what is your preferred measure of liquidity, and how do you think about where things stand today and maybe where things are going in terms of the liquidity picture?
So I think we can partially separate domestic liquidity from international liquidity because those are not exactly the same thing. And one thing I'll touch on about the whole inflation hedge thing before I continue answering that question is that, so part of my work is I track money supply growth quite a bit in different countries. And one thing you generally see is that Bitcoin has been historically very correlated with money supply growth, especially when you take global M2, so global broad money supply, and you translate it all back into dollars. And so the two big components there are, one, are a lot of countries printing money, and two, how is the dollar performing relative to those other big currencies, right? The euro, the UN, yen, all these kind of major currencies. And generally, when that's rising very quickly, especially in rate of change terms, that's usually historically coinciding with the last three Bitcoin bull runs. And when that starts kind of rolling over and consolidating, that's when Bitcoin has also historically kind of consolidated. And inflation historically comes somewhat after money supply growth. It's basically a side effect that happens on a lag. And so when people, the inflation that people saw taking shape in 2022 is in large part a result of actions that happened over 2020 and 2021. And so, for example, someone did buy Bitcoin well ahead of that. If they were anticipating inflation, if they, saw that, this kind of fiscal stimulus and money supply growth was happening, if they purchased Bitcoin, it did, protect them against the ravages of those inflation, just not perfectly timed with CPI that they see. So that's one thing I'll kind of point out, because now we're in the 2022 is the phase of the Fed fighting back on some of the things that happened in 2020, 2021. And then going back to the idea of liquidity, basically domestic liquidity indicators, there's been a popular ratio that I've seen floated around and I've incorporated into my own analysis. I used to do similar ways of adding it together, and I like this one a lot, so I incorporate it, which is basically you take the Fed balance sheet and then you also take the Treasury general account, because they have basically a cash account at the Fed, and any money in there is essentially dead money, right? So when that's growing, it's actually sucking money out of the system, and when that's shrinking, they're putting money back into the system. And so when you kind of take those together and you add things like reverse repos, you can get a liquidity measure that is actually rather correlated with risk assets in the United States. And when you look at a global liquidity indicator, in recent years, the dollar index is probably about as good as you're going to get, or dollar denominated global money supply. And that's because so many countries in the world have dollar denominated debts, right? The dollar is for the most part the unit of account for the world. That's changing somewhat over time, but most commodities are priced globally in dollars. Most international trade is denominated in dollars, and there's $13 trillion in dollar-denominated debt outstanding in the world. A lot of developing countries, when they borrow from international sources, it's done with dollars, and it's not even lent by Americans. Usually, it's usually Europeans, Japanese, Chinese. These, even though they're denominated in dollars, the lenders are all around the world because it's the global reserve currency. And so when you have the dollar strengthening relative to a basket of other currencies, essentially their liabilities are hardening compared to their cash flows. And vice versa, when the dollar is weakening, essentially their debts are getting devalued relative to their other currency cash flows. And so especially when that changes in a very kind of short period of time, like when it strengthens or weakens very rapidly, that can cause a liquidity squeeze or a liquidity loosening. So those are kind of some of the things I look at either domestically or internationally when talking about liquidity, which is already kind of a jargony topic to begin with.
Yeah, and I think it's important. And I like what you said in terms of Bitcoin's not going to be in line timing wise with CPI, because CPI is a lagging metric. Bitcoin in a lot of ways is a leading indicator, so in a lot of ways it front ran that. But Parker, this leads right into some of the things that you talked about in your recent piece. You said, from September 2019 to September 2021, the Fed increased the money supply by 4.7 trillion, doubling the amount of dollars in circulation. But it's almost unintuitive because you write how the world is still short dollars. And I think people would read that and be like, wait, they flooded the system with dollars, but the system is still short dollars. Can you maybe explain how that is possible? Because I know it's about this debt, right?
Yeah, and I think as Lynn was talking about cross-border dollar-denominated debt, I think Lynn quoted the number of 13 trillion. But if you look at the onshore, or the U.S. system-wide, as the Fed reports it in the Z1 report for the Financial Council of the United States, the total debt today is about 92 trillion. And that is very vanilla debt. So fixed liability, fixed maturity. It includes consumer debt, mortgages, credit card, auto loans, non-financial corporate sector debt, state, local, federal debt, and financial sector debt. And so if I went back all the way before the original financial crisis in 2008, there were about 52 trillion in dollar-denominated debt liabilities. Again, not including unfunded pension liabilities, not including derivatives, just the most vanilla debt that you could imagine. Some fixed amount of debt that's owed at a future point in time. It was 52 to 53 trillion at the end of 2007, and there was only $1 trillion. The Fed's total balance sheet was $1 trillion, and the go ahead.
Yeah, well, Pete, can you throw up that chart Parker had? Maybe we could talk through it because I think that's kind of what he's talking about right now.
Yeah,
Yeah.
helping people understand this dynamic that when the Fed comes in and digitally creates dollars, they effectively credit more dollars to be in the bank's accounts, and they buy some sort of debt instrument. And so around the financial crisis, they bought treasuries and then expanded that to include treasuries and mortgage-backed securities. And then in 2017, they started to withdraw dollars from about 4.5 trillion down to that 3.8 figure. And then following the repo market breaking in September of 2019, and then government shutting down the global economy and the printing that happened between March of 2020 and May of 2020, and then in the subsequent year and a half, the Fed effectively created 5 trillion new dollars. But while they're creating those dollars, the amount of debt that exists still by an order of magnitude now, previously orders of magnitude, exceeded the number of dollars that existed. So as the Fed's introducing more dollars, they're actually doing that because the credit system is starting to feed on itself. The system is starting to figure out that we're far more than $1 short, and they're introducing more dollars for in my view, the express purpose of allowing existing debt levels to be sustained, such that the entire debt stack currently of 92 trillion from feeding on itself and collapsing. And so I think the important thing to recognize is that while they're creating all this money, and while not everybody in the system is in debt at the individual level, and not every company is in debt, the system as a whole is functionally insolvent. And that if they didn't introduce these dollars, that system collapses. But the other consequence is that as they do it, everyone still needs to demand dollars. In my view, the dollar-denominated debt is what creates this high present demand for dollars. And that while not every dollar of that 92 trillion is due tomorrow or in a week, think about 30-year mortgages or 30-year treasuries. But what happens is that as the Fed starts to withdraw dollars, which is what they started, and when I'm talking about base money, that when they start to withdraw base money, basically everybody starts to figure out that financial conditions are tightening, and whether you have a debt that's owed in a year or 5 years or 10 years, you start to try to accumulate dollars in forecasting out when you're going to need to repay those debts. And so kind of two sides of it. Your most immediate question is that this is what the aggregate position looks like. So when they're introducing more dollars, there's still a bunch of people out there who've borrowed. And when I say they're short dollars, they owe dollars in the future that they don't have. And then when they start to reverse out and take dollars out, it has an outsized impact because when they're introducing more dollars, the amount of debt remains the same, and when they take dollars out of the system, at least in the order of magnitude, the amount of debt doesn't magically go away. There's just fewer dollars to satisfy the debt, and everybody starts to scramble. It essentially, when they start to withdraw debt for the system, it functionally creates a bank run from the weakest in the chain.
Right. And these huge liabilities, they create almost a present demand for dollars. And maybe that's why we saw a really strengthening dollar throughout 2021, which kind of wrecked all these other asset prices. It's really fascinating.
I would really say it's like once toward the end of 2021, they started to signal that they were going to raise interest rates. But really what I look at is they didn't start subtracting dollars out of the system until June of this year. And at the time when I wrote this article, I think that they had only withdrawn $350 billion relative to 8.9 trillion. But the key piece is that if every dollar is levered 10 to 1, that it has an outsized impact. And that is, if you have all these liabilities and you start to reduce the core building blocks of liquidity in the system, the dollar will strengthen because
Gotcha.
virtually everyone in the world, even everyone that's responsibly long Bitcoin, relies on the dollar economy and needs dollars to get very basic necessities met.